Hey guys, I'm Danny. This is Capital Cosm, but what this is not is financial advice. I am not a financial advisor. Everything in this video is for educational purposes only. Please do your own due diligence. So, has energy peaked? We've had a pretty strong rally in energy from 2020 up until the middle part of 2022. The question is, have we reached a crescendo? Have we reached a top? The S&P, the Dow, the rest of the stock market seems to be chopping down. We haven't seen any upward movement. We haven't reached the last all-time high somewhere in late 2021 in all of those markets. So the question is, how well is energy doing and how well is it doing relative to the rest of the stock market? We'll take a look at that, as well as oil. Oil is an energy resource, but how are oil companies and big oil positioning themselves for this green revolution? We'll take a look at how they're hedging their bets. Are they hedging their bets? We'll see. And then finally, we're going to look at markets. What makes a bear market? What makes a bull market? And how does market psychology figure into all of this? All that and more. So, we're going to look at all these different stories that I've aggregated on my Twitter page. If you haven't already subscribed to me on Twitter, if you have Twitter, that is, my handle is Capital Cosm. I've had this account for about a couple weeks now, but I basically just aggregate all the interesting stories that I find on FinTwit. So yeah, let's get started. The first tweet we're going to look at is from Gergen. I'm not even going to try to pronounce his last name because I know I'll butcher it, but he says, investors just don't like energy, period. End of story. It's extremely volatile with a lot of geopolitics surrounding it. And he's essentially referencing this chart by Zero Hedge. So let's open it up, take a look. And it's a series of box plots comparing the PE ratios of all of these different industries. This includes healthcare, industrials, real estate, and then energy here at the far right. A PE ratio is essentially a price to earnings ratio. So how high the price is relative to the earnings determines how overpriced an asset is. If your price outperforms your earnings, then you're an overpriced asset, and vice versa. We're going to look at all these different industries, all of these different asset classes, and see how they compare to the S&P's PE ratio. Remember, this is a comparative metric. So if the metric aligns with 1x, that means that asset class is tracking the S&P. It's not under or overperforming. But if it's anywhere above this 1x range threshold, then we are considered overperforming. If we are under this 1x threshold, then we are underperforming. All right. So the way to read these charts is essentially over the last 15 years, this data has tracked PE ratios across these various industries and compared each of those years to the S&P's PE ratio. 50% of that data lies within this box. This box contains everything from the 25th percentile here at the bottom part of this box all the way up to the 75th percentile of data located at the top of this box. Anything above that is 75 percentile and up. Anything below that is below the 25th percentile. And your tops and bottoms are your most extreme data points, are your most extreme years of under or over performance relative to the S&P. So a diamond here signifies the current year. What's interesting about this is if you look at energy, the current year of energy has underperformed the S&P by 0.5x. Phrased a different way, the S&P has overperformed energy by a factor of 2, despite the huge run-up we've seen in energy, despite the massive correction in the S&P. We're still lagging behind the S&P by a factor of 2. We being the energy sector. So if you look across all of these different sectors, these different asset classes, nothing even comes close this year to energy. So it looks like energy is underperforming the S&P. Let's take a look at another piece of data. I have here the Vanguard Energy ETF. This is where we're currently sitting at today, and this chart currently goes all the way back to 2005. Now, it doesn't look like we're underperforming anything, right? I mean, we're almost near the highs of 2008. We're almost near the highs of 2014. So where is this value? Where is this value of which I speak of? Well, one thing to consider, first and foremost, is that we printed out a ton of money in 2020 and 2021. In fact, 40% of the M2 money supply, which is your broad money metric, 40% of the money in circulation today was created in those 2 years. So we have more dollars chasing probably fewer goods of energy than we did back in 2008. How do I know this? Well, let's look at this very same ETF and let's divide it by the M2 money supply. And the reason why we do this is because this gives us a ratio. The lower a downward trend that signifies underperformance. An upward trend signifies overperformance. Now, look at this. Look at this decade-long time horizon. Look at this decade-long trend down. I can draw a support line all the way out here, and we can see, the strength of a support line, or rather, sorry, this is a resistance line. My bad. The strength of a resistance line, or a support line for that matter, is number one, determined by its longevity. How long is this support line? How long is this resistance line? How many times do we hit our heads on this resistance line? We hit our heads here, we hit our heads here, here, and here. So we've tested this resistance line. The more we test it, the more valid it becomes. And the more it matters when we finally break out of it, which is what we did here in the middle of 2021. We've been outperforming the S&P for pretty much a year now. But if you look at it from a year-to-date perspective, not even a year-to-date, but really since the early summer, late spring, we've kind of been chopping sideways here. But nonetheless, we still have a ways to go until we finally come close to the old 2008 highs once we control for the money supply. We have a lot more money in the system today than we did back then. So another thing worth looking at is the very same ETF, the energy ETF, divided by the S&P. We're going to be using the SPX, which is an S&P 500 ETF, as our proxy for the S&P. And what do we have? Pretty much the same pattern. We've had a decade-long decline in energy relative to the S&P, and then finally we broke out of it at the tail end of 2021, and we've been moving up. We're in a bit of a correction right now, but nothing moves in a straight line. Nothing at all. So energy has been underperforming the S&P, has been in a bear market versus the S&P for a long, long time. And we've finally broken out of that downswing, that downtrend. So things are looking good for energy. Let's also look at commodities. Commodities are a superset of energy. Energy is but a subset of commodities. Commodities looked at by themselves, through their own lens, we're not particularly near the top, but doesn't look particularly cheap. But if we apply the same standards as we did with energy, we're going to see the same story being told. And what do we see? Decade-long downtrend, finally broke out of it in 2021, and now we're sort of in a consolidation phase here in the greater part of 2022, since about the summertime. If we look at it from the S&P perspective, again, I mean, we are so underpriced relative to the S&P for our commodity stocks. Look at this. Look at it. Despite this huge run up, right? We went from a ratio of 0.0341. We're sitting at 0.067. That's a doubling of the ratio. But look at all this upside we've yet to make up for the prior high. If we want to get back to these old levels, I mean, we've got to outperform the S&P by a factor of 5, going from 0.67 to 0.36. So lots of asymmetric potential in energy and in commodities. All right, so let's segue into the oil market. More specifically, the oil. So big oil in particular. So big oil says here, this is an article from Bloomberg. The world's biggest oil producers are betting billions on a global climate catastrophe. So let's dig into what this means. Looks like this is behind a paywall. But the gist of this article is that big oil has been pumping in a lot of money into ONG projects, oil and gas projects. Now, the tune of $58 billion, this would not have been spent if big oil was predicting an electrified green economy in the near future. The fact that they spent this much money in the last 2 years tells us that big oil is betting against the electrification of the grid, the greening of the energy economy. And in fact, what you could see in this article, had it not been blocked, was that big oil is actually anticipating spending another $23 billion in 2023. So, despite all the rhetoric of wanting to greenify the economy, the big money in big oil, they're putting skin in the game in the opposite direction. Here I write, hint, it's because they know the materials needed for the green future simply do not exist in enough quantities on this planet. What do I mean by that? Well, the amount of copper, the amount of lithium, the amount of cobalt, the amount of nickel that we would need to excavate on a societal level to meet the goals and needs of the electrification of the grid would have to overwhelm the existing amount that we've already excavated in human history. We would need to excavate more in the next decade than we have in human history for a lot of these battery metals, for these electrical vehicles, for these solar panels, for these windmills, wind turbines, surprisingly enough, that are built on coking coal. But regardless, the amount of resources needed to excavate and carve out the earth is it is a Herculean effort that will be required. And it doesn't look like the big money makers at big oil are hedging their bets on that. They're actually betting on the opposite, which is we're not disavowing hydrocarbons in at least the near term. So let's wrap things up here. This is a pretty cool visual of the psychology of the market cycle. It's basically an abstract of what determines a bear and a bull market and the psychology that's kind of associated with each of these different markets. They break it down into these different levels that we'll go into. And so we start off at disbelief. Disbelief is when things have been a wasteland from a buying perspective. There's no one, you have an asset, it's been chopping sideways or chopping down or been in a bear market for, 5, 10, 15 years. And, anyone that had capital in this thing has already left. You've essentially exhausted out all of your sellers. There's no one left to sell. We can kind of look at this in terms of our energy assets. Here on the energy front, and even here on the commodity front, we had this decade-long bear market where we just grinded down and down and down. There's like no end in sight. And this is really where the savvy investor, in an ideal world, this is where you'd want to buy. This is when you have maximum asymmetry in an asset. What do I mean by asymmetry? Asymmetry is when you have all this upside here. All this upside, pretty much limitless upside technically, because your upside is infinite from a technical point of view. But you have limited downside. So it doesn't really hurt to put a percent or two, maybe 5% in a sector that's been destroyed over a long enough period of time. Once you start seeing some buyers come in, once you've come to the point where you've exhausted out all your sellers, you're going to have more buyers than sellers. What happens when there's more buyers than sellers? The price starts to rise. That's all the market essentially is. The market is a battle between buyers and sellers on a psychological level. The market is based on buyers and sellers and their confidence as well as their psychology. Once investors start seeing some upward price action, this is when you see your easy money being made. It doesn't really take much to move an asset once it's been distressed for a number of years. And once gains are being made, this is where you start seeing what's called smart money come in. These are your hedge funds. These are your family offices. These are your capital money managers. These are the people that get in early before the big rise up. They haven't gotten in during the disbelief stage because they still have to satisfy their clients' needs. They're going to have to try and explain as to why they're buying this distressed asset. But once there's some momentum behind it, it makes more sense. They have more ammo to say, hey, we've seen this asset move 50%, 100%, whatever it is in the last 1 or 2 years. Let's get into it. Let's be one of the first ones in. Once that happens and you start seeing a consecutive move up, a more stretched out upside move, that's when you enter your optimism phase. That's when the rally has become real. We've seen there's sufficient evidence that a rally exists. We've moved up all the way down from here to all the way up to here. All right. So this is the very early stages of when the larger retail side begins to take notice. This is when you probably start seeing CNBC or Bloomberg or any of these mainstream investment and finance channels start talking about an asset. Once that takes form, the next step is the belief stage. This is when people begin not just allocating 1 or 2% or whatever it is into a given asset or a sector. This is when they up their investment allocation from 2% to 5% to maybe 10%. This is when more confidence, this asset has proven its worth. This asset has proven itself that it is no longer in a in a prolonged bear market. It has broken out. And once that takes hold, that's when your retail comes in en masse. This is thrill. This is this thrill phase. I will buy more on margin. I will go into debt to buy stocks. I will take equity out of my house to buy Bitcoin. That's what happened in 2020 and 2021. You had a bunch of people download Robinhood, and basically doesn't really matter which stock you bought. Doesn't really matter your portfolio. You could throw darts at a board with a bunch of random stocks or cryptos on it, and no matter where it hit, you're probably going to do fine. And that's when euphoria sets in. Everyone becomes a genius in their own mind because everyone's making money. We're all going to be rich. This is a brand new paradigm. Stocks only go up. Remember that? Stocks only go up. This is what one of my favorite investors, Jim Rogers, talks about. The most dangerous words that could come from an investor's mouth is, this time it's different. When people think that stocks only go up, then when people think that we have reached a new paradigm, that is when things have topped out. That is when that sets hold of people's mind, people are motivated to put more and more of their capital, and more people are motivated to put their capital in. So when that happens, where are you going to find any more buyers to take this thing higher? You're not. You've exhausted all of your buyers. You go to get your hair cut, your barber's telling you to buy Bitcoin. You take an Uber from your house to downtown, and your Uber driver's telling you to buy Doge. There's no one left to buy. There's no one left to buy anything. You've exhausted all of the potential buyers. At this point, you have more potential sellers than you have potential buyers. And what happens when the sellers overtake the buyers? The price comes down, and this is what happens next. You have your first leg down. This is called complacency. We just need to cool off a bit for the next rally. Buy the dip. We've been buying, so on our way up here, it's not a straight line. There's ups and downs, but the overall trend is up. Higher highs and higher lows. People mistake the first leg down as another run-of-the-mill dip. And they buy the dip because they're still acting on the old bull market paradigm. They still have not realized that the market has topped, that everyone with any liquidity has already put that liquidity into the market. This is why being a contrarian is always essential. Because if everyone's on one side of the boat, then the boat's going to flip over. So we go through complacency, but we have a first leg down and then what's called a dead cat bounce. We have people buy it up because they think it's just another run-of-the-mill dip. We go back up. But as you'll notice here in this abstract, in this visual, we don't reach the old highs. We retrace a certain portion of it up, but not all the way. When we see a big enough sell-off like we do here, then fear begets fear, no matter how small. And that elicits more selling. And then we reach anxiety. This is when things become real. Why am I getting margin calls? This dip is taking longer than expected. This is when people, investors, traders wake up and start to smell the roses. This is their come to Jesus moment, that something is different. Something is wrong about this dip. This is lasting a lot longer than these old dips here did. Okay? So we see more selling, less confidence in the market. Next step is denial. There's acceptance of the fact that we are in a bear market, but there's denial in the fact that you're holding the bad apples. Yeah, the market overall is going down, but not my portfolio. I have a bunch, I have great companies. I truly believe in these companies. They've got really good PE ratios. They've got really good earnings. So what if the market's down? These are still evaluated fairly. Okay, the market's mean reverted. But the problem with the market when it reverts back to its mean is in both directions, it overshoots. It overcorrects to the downside as in the same way that it overcorrected to the upside. When we were back here in disbelief, things were incredibly underpriced. But did the market just revert back to fair value and stop there? No, the market reverted back to fair value and went even further to the point of euphoria. This is just the same side of the coin, different side of the coin. Same coin, different side. In panic, everyone sells. I need to get out. Capitulation comes next. I'm getting 100% out of the markets. I can't afford to lose anymore. I've lost 70, 80%. You know what? I'm just going to cut my losses and take 20 to 30% of the money that I still have in my account, because I may as well keep 20 to 30% and then not keep any at all. People have capitulated. The sellers have eviscerated the buyers. There are no more buyers. Everyone is a seller. And once we've hit that point, anger kicks in. People understand that they've lost everything. And the next thing that they want to do, they want someone or something to blame. Anger. Who shorted the market? Why did the government not step in? Why did the government allow this to happen? We go through that. And then after enough time, we go through this prolonged bear market and people come to depression. I've lost all my money. How can I pay for all this new stuff that I bought during good times on this side? I'm an idiot. Blah, 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 blah. And then you've pretty much shaken out all the sellers. There's no one left to sell. Everyone's 100% out for the most part, generally speaking. So what happens next? Disbelief. Sound familiar? Yep. It takes us all the way back here to the very start of the graph. And then we repeat the same thing over and over and over and over again. Remember what Jim Rogers said. The most dangerous words to come out of an investor's mouth is that it's different this time. Generally speaking, there's nothing new under the sun. The market is cyclical. Well, that's all I've got today, guys. Let me know what you think. Let me know where you think we are, actually, on this graph. Do you think the overall market's already in anxiety, or are we still in complacency? Where do you think we are in our energy and commodity stocks? Are we also on the second half of this graph? Are we in complacency or anxiety or in denial? Let me know. Let me know in the comments below. I'm really interested in knowing what you guys think. Let me also know if there's anything else that you want me to talk about. Give me a like if you like this video, obviously, but give me a dislike if you didn't. Let me know what I can do to change. Let me know what you want me to cover, and I greatly appreciate your time. Be sure to subscribe to this channel, and also subscribe to my follow me on Twitter. If you have Twitter, that is. My handle is Capital Cosm. Happy to have you there as a follower. I post every day there. And a lot of the stuff that I post there, we cover here on this channel. So it's a double whammy. All right, guys, you have a good one. Until next time.